You sign the mortgage papers. 360 payments. 30 years. $1,016.03 per month on a $250,000 loan at 7% interest. Feels manageable, right? You can afford that payment. The house is worth it. You shake hands with the loan officer, and you just agreed to pay almost $600,000 total for that $250,000 house. $349,000 goes straight to the bank as pure profit. Nearly 1.4 times the purchase price just disappears into interest payments. And here's the part that should make you angry. Nobody told you that number. They showed you the monthly payment. They showed you the interest rate. But they never put that final number on the page in bold letters. You will pay $349,000 in interest over the life of this loan. Because if they did, you might have asked some uncomfortable questions. Welcome to the biggest financial transaction of your life, where the real cost is hidden inside 30 years of payments that feel normal until you actually do the math. My name is Alex, and I've spent the better part of a decade analyzing mortgage amortization tables so you don't have to endure that particular form of spreadsheet torture. If you want to understand how money actually works and stop getting quietly fleeced by financial systems designed to keep you in the dark, make sure to hit that subscribe button and give this video a thumbs up. Today, I'm going to show you exactly how mortgage interest works, why your first payment barely touches your principal balance, and 4 specific strategies with exact numbers that can save you 6 figures in interest and shave years off your mortgage. Not theory, not vague tips, actual math you can use tomorrow. Here's what makes this so insidious. When you make that first mortgage payment on your $250,000 loan at 7% interest, you're paying $1,663. Feels productive, right? You're paying down your house. Except that $1,663 splits into $1,458 in interest and only $205 in principal. You just sent the bank $1,458 for the privilege of borrowing their money for 1 month. $205 went toward actually owning your house. That's 12% of your payment going to equity. 88% is pure interest. And that ratio doesn't flip for years. By payment 12, you've sent the bank almost $20,000 and reduced your loan balance by less than $3,000. This is how amortization works, and it's perfectly legal, completely standard, and designed to maximize bank profit while minimizing your wealth accumulation for the first decade of your mortgage. Now, I can already hear the objection forming in your head. Interest rates are just how loans work. The bank is taking a risk. They deserve compensation. Sure, absolutely. But here's what they're not telling you. The system is structured so that you pay the maximum possible interest even if you have the ability to pay faster. The 30-year mortgage became the American standard not because it's optimal for homeowners, but because it maximizes total interest paid while keeping monthly payments low enough to qualify more borrowers. It's a sales tool disguised as affordability. And in the current 2025 rate environment, where 30-year fixed mortgages are hovering between 6.5 and 7%, according to Freddie Mac's primary mortgage market survey, that interest cost is massive. Just 2 years ago, rates were under 3%. A $250,000 mortgage at 3% costs $134,000 in interest over 30 years. At 7%, that same mortgage costs $349,000. That's a $215,000 difference. Same house, same principal. But the interest more than doubled because rates went up 4 percentage points, and most people just accept this as inevitable. What I'm about to show you next is the thing that took me years to figure out and that banks absolutely do not advertise: how to weaponize extra payments to demolish that interest burden. Let me walk you through how amortization actually works, because once you see the mechanism, you'll understand why extra payments are so powerful. Every month, the bank calculates interest on your remaining balance. That interest gets paid first. Whatever's left of your payment goes to principal. Month 1 on our $250,000 loan, balance is $250,000. Monthly interest at 7% annual is $250,000 times 0.07 divided by 12 months, which equals $1,458. Your payment is $1,663. Subtract the interest, and $205 hits principal. New balance $249,795. Month 2, interest is calculated on $249,795. That's $1,457 in interest, $206 to principal. Month 3, $249,589 balance, $1,456 in interest, $207 to principal. See the pattern? Each month, your balance drops by a tiny amount, which means next month's interest charge drops by a tiny amount, which means a tiny bit more goes to principal. It's a slow, grinding process. By payment 60, 5 years in, you've paid $99,780 total. Your balance is still $229,000. You've reduced your principal by $21,000 over 5 years while paying $78,000 in interest. That's a 3.7 to 1 ratio of interest to principal reduction. This is why it feels like you're getting nowhere for the first decade. Because you're not. The system is designed to front-load interest. But here's where it gets interesting. If you understand the mechanism, you can hack it. Every extra dollar you pay beyond your required payment goes directly to principal, not interest. Principal. And when you reduce principal, you reduce the balance that next month's interest is calculated on, which means less interest next month, which means more of your regular payment goes to principal next month, which means even less interest the month after that. It compounds, in reverse. Instead of debt compounding against you, you're compounding against the debt. Let me show you what this looks like with real numbers. Strategy 1. Extra $100 per month. You take your $1,663 payment and round it up to $1,763. One extra $100 per month. That's $1,200 per year. Feels small, right? Here's what it does. Your mortgage pays off in 25.2 years instead of 30. You save $66,670 in interest. You shave 4.8 years off your mortgage. $100 per month bought you nearly 5 years of your life back and saved you enough money to buy a decent car with cash. Why does this work? Because that $100 in month 1 reduces your balance to $249,695 instead of $249,795, $100 less, which means month 2's interest calculation is on a balance that's $100 lower. So you save 58 cents in interest that month. That 58 cents goes to principal instead. Month 3's balance is now lower by $100 plus 58 cents, so you save another 58 cents in interest. This snowballs. By year 5, that extra $100 per month has reduced your balance by over $7,000 more than the regular payment schedule. And because interest is calculated on remaining balance, you're saving hundreds of dollars per year in interest charges that would have been paid if you'd stuck to the regular schedule. Strategy 2, extra $250 per month. Now we're getting aggressive. You're paying $1,913 per month instead of $1,663. That's $3,000 extra per year. Here's the payoff. Your mortgage pays off in 20.6 years. You save $126,200 in interest. You cut 9.4 years off your mortgage, nearly a decade, for $250 per month. Think about that math. 250 times 12 months times 20.6 years equals $61,800 in extra payments. You spend $61,800 to save $126,200. That's a 2.04 to 1 return. Where else can you get a guaranteed 7% return with zero risk? Nowhere. This is the single best investment most people will ever have access to. Better than the stock market average, better than bonds, better than real estate appreciation, because it's guaranteed. Every extra dollar you pay saves you exactly 7% per year in interest you won't have to pay. And it's tax-free savings because you're not earning income, you're avoiding expense. Now we're getting to the part that actually matters. Stay with me here, because this next strategy is where most people get confused, but where the magic really happens. Strategy 3. Lump sum payments. Let's say you get a tax refund, or a bonus, or you sell something. You have $5,000 sitting there. You could invest it. You could blow it on a vacation. Or you could make a one-time extra mortgage payment. Let's run the numbers on that. You make a $5,000 principal payment in month 24. 2 years into your mortgage, here's what happens. Your balance at month 24 on the regular schedule would be $244,500. You pay $5,000. New balance $239,500. That $5,000 reduction means every single future interest calculation is based on a balance that's $5,000 lower. Over the remaining 28 years, that saves you $28,730 in interest, and it cuts 1.7 years off your mortgage. 5,000 becomes 28,730. That's a 5.75 times multiplier. This is what banks don't want you to understand. A single strategic payment early in your mortgage has exponential impact because it affects every subsequent payment for decades. The earlier you do it, the bigger the effect. That same $5,000 payment in month 120, year 10, saves you $19,000. Still incredible. But less than the month 24 payment. Timing matters. Front-loading extra payments maximizes impact. If you've made it this far, you're already ahead of 90% of people who will just accept their 30-year sentence without question. But don't stop now, because the next strategy is the one that requires the least lifestyle change and still produces massive results. Strategy 4. Biweekly payments. Instead of paying $1,663 once per month, you pay $831.50 every 2 weeks. Same monthly budget. You're not paying extra per month. But here's the trick. There are 52 weeks in a year. 52 divided by 2 is 26 bi-weekly payments. 26 payments of $831.50 equals $21,619 per year. Your regular monthly payment times 12 months equals $19,956 per year. The bi-weekly schedule gets you to $21,619. That's $1,663 extra per year, the equivalent of one full extra monthly payment. And you didn't change your lifestyle at all. You're just paying half your mortgage every 2 weeks instead of the full amount once a month. Here's what it does. Your mortgage pays off in 23.7 years instead of 30. You save $86,500 in interest. You cut 6.3 years off your mortgage for zero lifestyle change. You just shifted when you make the payments. This works because you're making that one extra payment per year, and it's happening automatically in small increments. The math is exactly the same as if you made one extra monthly payment per year as a lump sum, but psychologically it's easier because you never see that money as available spending money. It just goes straight to the mortgage every 2 weeks. Now let me show you something that'll make your head spin. Let's compare all 4 strategies side by side with our $250,000 mortgage at 7%. Regular payment schedule, 30 years, $349,000 in interest, $599,000 total paid. Strategy 1. Extra, 100 per month, 25.2 years, $282,330 in interest, $532,330 total paid. Strategy 2. Extra 250 per month, 20.6 years, $222,800 in interest, $472,800 total paid. Strategy 3. 5,000 lump sum in month 24, 28.3 years, $320,270 in interest, $570,270 total paid. Strategy 4. Bi-weekly payments, 23.7 years, $262,500 in interest, $512,500 total paid. The spread between doing nothing and doing strategy 2 is $126,200 and 9.4 years. That's not a rounding error. That's a new car, a kid's college fund, or early retirement. But here's where most financial advice stops, and here's where I'm going to take you deeper. The real magic happens in your brain. Because understanding the math is one thing, actually executing on it is something completely different. And this is where the psychology matters more than the arithmetic. Most people know they should pay extra on their mortgage, but they don't. Why? Because the mortgage payment feels fixed. It's a bill. Bills are non-negotiable. You pay exactly what you owe and not a penny more. That's the mental frame. Meanwhile, discretionary income feels flexible. That extra $200 per month could go to the mortgage, or it could go to dinners out, or new clothes, or a slightly nicer car lease. And because there's no immediate consequence to not paying extra on the mortgage loses. You'll feel the pain of skipping dinner out tonight. You won't feel the pain of paying an extra $30,000 in interest over the next 20 years. The pain is distant and abstract. The pleasure is immediate and concrete. This is why people stay in debt, not because they don't understand interest, but because their psychology is wired for short-term reward over long-term optimization. Here's what has to shift. You have to reframe the extra mortgage payment from optional to mandatory. It's not extra, it's part of the payment. The bank told you the payment is $1,663. You tell yourself the payment is $1,900. That's the number. Non-negotiable. The $237 difference isn't available for spending. It doesn't exist. It's already allocated. This is a mental game, and you have to win it. Because if you treat it as optional, it'll never happen. There will always be something else. Always. The Consumer Financial Protection Bureau requires lenders to disclose total interest paid over the life of the loan on your closing documents. But nobody reads those documents carefully. And even if they do, the number is so big and so distant that it doesn't register emotionally. $349,000 in interest sounds made up. It doesn't feel real. What feels real is the $1,663 you pay this month, so you optimize for this month. And you lose. Let me give you a framework that actually works. Calculate your total interest saved for every extra payment strategy. Write it down. Put it somewhere visible. Every month, when you make that extra payment, you're not spending money. You're capturing future savings that already exist. That extra $250 this month isn't an expense. It's a $28,000 future tax refund that you're claiming right now. That mental reframe matters. It turns the extra payment from a sacrifice into a victory. You're not losing $250. You're banking $28,000 in future savings. Once you see it that way, the decision becomes obvious. Here's something else nobody talks about. The rate environment matters. A lot. Back in 2020 and 2021, 30-year mortgages were at 3%. At 3%, the math on extra payments still works, but the returns are smaller. A $250,000 mortgage at 3% costs $134,000 in interest over 30 years. Extra $250 per month saves you about $48,000 in interest at 3%. Still good. But at 7%, that same strategy saves $126,000. The higher the rate, the more powerful extra payments become. Why? Because you're saving 7% per year instead of 3% per year. Every extra dollar has more than double the impact at 7% compared to 3%. So if you're sitting on a mortgage originated in 2022 or later when rates spiked, you have the highest incentive in modern history to pay it down aggressively. Your return on extra payments is enormous. If you refinanced at 3% in 2021 and you're still sitting on that loan, your incentive is lower. Still positive. Still worth doing, but less urgent. This is why you can't just follow generic advice. You have to run your specific numbers with your specific rate. Let me walk you through one more scenario that combines everything. You have our $250,000 mortgage at 7%. You implement strategy 2, extra $250 per month. That alone gets you to 20.6 years and saves $126,200. But then, in year 3, you get a $10,000 bonus. You make a lump sum payment. Now your payoff drops to 18.1 years, and your total interest saved jumps to $148,000. Then you switch to bi-weekly payments for the psychological automation. Because you're already paying extra, the bi-weekly schedule doesn't add much more, but it ensures you never skip a payment and it sneaks in another half payment per year. Final result, mortgage paid off in 17.3 years. Total interest paid, $191,000. Total saved, versus the original schedule, $158,000. And you bought yourself 12.7 years of your life where you don't have a mortgage payment. 12.7 years where that $1,663 per month can go to retirement accounts, kids' college, travel, or just sitting in investments compounding. That's the real win. Not just the interest saved, the freedom gained. Now let me tie all of this together, because when you see how these pieces connect, everything changes. Mortgages are designed to maximize bank profit through front-loaded interest amortization. Your first 10 years of payments are almost entirely interest. This is by design, not accident. But the system has a vulnerability. It recalculates interest every month based on remaining balance, which means every extra dollar you pay permanently reduces the balance and eliminates future interest that would have been calculated on that dollar. This is a compounding effect in reverse. The earlier you start, the more powerful it becomes. Extra 100 per month saves 66,670. Extra 250 per month saves 126,200. A $5,000 lump sum early saves 28,700. Bi-weekly payments save 86,500. Stack these strategies and you can cut your 30-year mortgage to under 18 years while saving over $150,000. The math is simple. The psychology is hard. You have to reframe extra payments from optional to mandatory. You have to feel the future savings now instead of the present sacrifice. And you have to understand that in a 7% rate environment, every extra dollar you pay returns 7% per year guaranteed with zero risk. That beats almost every other investment available to regular people. Here's what this looks like at different interest rates, because I know some of you refinanced at lower rates and you're wondering if this still applies. Same $250,000 loan. At 4% interest, your standard payment is $1,194. Total interest over 30 years, $179,674. Extra $250 per month at 4% saves you $59,900 and cuts 6.7 years off the mortgage. At 7%, we already know the numbers, saves $126,200 and cuts 9.4 years. The higher the rate, the more you save. But even at 4%, $59,900 is life-changing money, and 6.7 years of freedom is still 6.7 years. So yes, it still works. It's just less dramatic than in high-rate environments. If you're sitting on a 3% mortgage from 2021, your extra payment savings are around $40,000 to $50,000 depending on amount. Still absolutely worth it. Just not as urgent as the 7% mortgages that are standard in 2025. One more thing before we wrap. Some people hear this and immediately think, shouldn't I invest that extra money instead of paying down the mortgage? Valid question. The math says if you can consistently get higher than 7% returns after tax in the market, you're better off investing. Historically, the stock market averages around 10% before inflation. After inflation, it's closer to 7%. So theoretically, it's a wash. But here's what that logic misses: guarantee and behavior. Your mortgage payoff savings are guaranteed. The market is not. The market could return 12% next year. Or it could drop 30%. Your mortgage interest savings are locked in, 7% per year, every year. No volatility, no risk. And behaviorally, most people don't actually invest the difference. They say they will. But that extra $250 per month ends up going to lifestyle instead of index funds. Paying down the mortgage forces the savings. It's automatic, it's visible, and it compounds. So unless you have the discipline to automatically invest every extra dollar into a retirement account and never touch it, paying down the mortgage is probably the better move. Especially if you're over 40 and looking at retirement in 15 to 20 years. Being mortgage-free at retirement is worth more than an equivalent amount in a brokerage account because it eliminates a major fixed expense. Almost there. But before I wrap up, I need to show you how all of this works together as a system, not just isolated tactics. You're not just making extra payments. You're building a wealth acceleration system. Step 1. Understand the amortization mechanism so you see why extra payments work. Step 2. Choose your strategy based on your cash flow and psychology. If you have a regular income, lump sums work better. If you have steady paychecks, monthly extra payments, or bi-weekly schedules work better. Step 3. Automate it. Don't rely on willpower. Set up automatic extra payments or bi-weekly drafts so it happens without decision-making every month. Step 4. Track your progress. Log into your mortgage account quarterly and watch your payoff date move closer. That visible progress creates motivation to keep going. Step 5. Stack strategies when possible. Start with bi-weekly payments for the base. Add one-time lump sums when windfalls hit. Increase your monthly extra as your income grows. The strategies multiply each other's effects. This isn't about suffering or deprivation. It's about redirecting money that's currently disappearing into bank profits toward your own freedom instead. Your future self is counting on you to understand this. 10 years from now, you'll either be looking at a mortgage balance that barely moved while you poured $100,000 into interest, or you'll be looking at a payoff date that's years closer and savings that hit six figures. The choice is made today, not someday. Today. You can keep making the minimum payment and telling yourself you'll pay extra later when you have more money. That's the trap. There's never more money later. There's always something else. Or you can reframe that extra $200 per month as non-negotiable and start claiming your future savings right now. That $200 is either going to the bank as profit or it's staying in your wealth column as equity and eliminated interest. Those are the only two options. And the difference between those options over 20 years is $100,000 and most of a decade of your life. You're not pushing that boulder uphill anymore. You've built a system where every dollar works for you instead of against you, where compound interest reverses direction and starts demolishing debt instead of building it, where your mortgage becomes a tool you control instead of a sentence you serve. That's the shift, from passive borrower to active wealth builder, from victim of amortization to master of it. The math was always there. The banks just hoped you wouldn't bother to learn it. Now you have. What you do next determines whether you pay $349,000 in interest or $191,000, whether you're mortgage-free in 30 years or 17, whether that monthly payment controls your life for 3 decades or less than 2. The numbers don't lie. The system doesn't change. But your relationship to it can, and that makes all the difference.